Hello, everyone. We'll be looking at Chapter 8. Okay, Chapter 8. What Chapter 8 looks at is several things related to long-term assets. So Chapter 8, basically one of the premises in Chapter 8 is that the cost of a long-term asset is its cost plus whatever it takes to get it to its intended condition for use. So that would kind of be the premise of Chapter 8. So if you think about equipment, for example, it would be the cost of the equipment plus the sales taxes, shipping cost, installation fee, and testing cost for a total cost of the equipment of $12,375. So the total cost of a long-term asset is whatever they pay for it plus whatever it takes to get it to its intended condition. Now, land improvements, this is a new account in this chapter, and this would represent any improvements you make to land that can be depreciated. So land improvements would be things such as fences, lights, parking lots. And the reason that they set them up as separate accounts is because these are things that can be depreciated. And one thing to think about here is land is the only asset that is not depreciated. Vehicles, buildings, all of those are depreciated, but land is not depreciated. Now, one other topic I wanted to talk about is a lump sum purchase. And a lump sum purchase is a situation where a company would pay one amount for multiple long-term assets, typically 2 or 3 together. And the thing is, how do you assign cost to those items? So let's say we buy land in a building for $80,000. Now, the market values would be $60,000 for the building, $40,000 for the land, a total of $100,000. So if we were to take the 60 and divide it by the 100, 60% of the total market value would be related to building, and 40% would be related to the land based on market values. So the easiest way to divide out a lump sum purchase between two assets as far as what cost to give each asset would simply be to take the $80,000 lump sum purchase times 60% would give us $48,000 for the building, and times 40% would give us $32,000 for the land. So basically, that's how we would account for the total purchase price in this case. Now, another example would be, what if we, well, actually, let's not do that example. Let's not do that. Let's just go ahead and move on. So I wanted to go ahead and move on to the most important thing from the chapter, and that would be depreciation. And depreciation was covered in an earlier chapter with the adjusting entries, just very basically. But remember that the cost of an asset, of course, would be what you pay for it. Useful life would be how long you intend to use the asset in the business. And salvage value would be what the asset is going to be worth at the end of its useful life. So the one method of depreciation looked at earlier in the chapter, or earlier in the course, was straight line depreciation with the adjusting entries. Straight line would be depreciation based on time. So even if you didn't use an asset, you would still depreciate it because straight line depreciation is only based on time. So in this example here, we would take our cost minus our salvage value and divide it by the useful life. And this is this is kind of an example of that. So let's say on January the 2nd of 21, we go out and we purchase a new truck with a cost of $36,000 for our business. We have a useful life of 5 years and a salvage value of $6,000. So we take the cost minus the salvage value, that would be 36 minus the 6 would give us 30, divided by the useful life of 5, $6,000 per year would be our annual depreciation. So in this example here, we would debit depreciation expense for $6,000 and credit accumulated depreciation. Now, if we were doing this on an annual basis, then we would do this on December 31st. So on December 31st, end of the year, we'd go in and do this entry. So we could also decide to record it monthly. And if so, then basically we'd take the annual amount, divide it by 12, and we would get $500 per month. And in that case, at the end of January, February, March, April, we'd make the same entry every month as we went along. So we'd debit depreciation expense and credit accumulated depreciation again. So now, what if the truck was purchased on April 1st instead of January 2nd? Then we would only record depreciation for 9 months in 2021. So we'd take the cost minus the salvage value, or let's say we had a cost of 30,000, a salvage value of 6, or let's say our cost minus our salvage value would have been 36,000 minus 30. We'll just do the last example. But if the last example was bought on April 1st, then we only had it for 9 months during the first year. So if we were recording depreciation on an annual basis, we'd take the cost minus the salvage value, divide it by the useful life, and we'd get 6,000 per year. Now, in the first year, only in the first year, we'd take 9 divided by 12 because we would have only owned it for 9 months of the year. So we'd only need to do depreciation for 9 months. And so that would give us first year depreciation of 4,500. So our entry in this case would have only been for 4,500 in year 1, because if we were doing it by year, we would only record it for how much of the year that we owned the asset in year 1. Now, if we were doing it by month, it really wouldn't matter, because we'd start at the end of April, recording for $500, and we'd do it at the end of May, the end of June, every month. And so that would basically be, how we would record depreciation per month going through the rest of the year. Now, what this would look like on the balance sheet is the asset truck is always going to be recorded at cost, less the amount of accumulated depreciation, which would be 1 year of depreciation. The book value then would be 30,000 of the difference. So cost less accumulated depreciation equals the book value of the asset. Now, the reason we do it this way in accounting is this allows those that use or look at the financial statements to see how old an asset is. If the book value is close to the cost, then it's a pretty new asset. If the book value is far away from the cost, then we would know that this is an older asset that's been mostly depreciated. Now, accumulated depreciation is a contra asset. We looked at this one early on in the course. A contra asset is an asset that's related to another account. In this case, it'd be related to an asset, and it has a balance just the opposite of the account that it's related to. So what this means is that we would have, in this case, accumulated depreciation of 6,000. Notice it has a balance just the opposite of the account it's related to, which is the truck. And again, the difference between the cost and the book value would be the contra asset in this case. Now, let's look at another method. Let's look at the units of production method. Now, units of production is different than straight line. Units of production is depreciation based only on usage. And the first thing you want to do is you want to find the rate. And the rate would be the cost minus the salvage value divided by the total units of production that you're going to make. Now, again, it's depreciation based on usage. So one thing I'll say is it's only really good for some assets where usage can be judged, such as a truck or equipment. And notice some of the usage or the units or usage that typically is going to be used for these. Notice that like a truck, it's going to be miles driven. Equipment, it's going to be hours used. Or it could be units produced for equipment. These would all be good measures of usage of a long-term asset. So one thing to think about this is that it's not so much how long you have the asset, it's just how quickly do you use it up. So let's look at an example. Let's again say we had a truck. We purchased it on the 2nd of January. Then the same example as the first one. Cost of $36,000, useful life of 5 years, salvage value of $6,000. Now, the miles driven, year 1, year 2, 3, 4, and 5, total miles driven would be 100,000 miles. So basically what we would do in this case is if we want to find the rate, we would take the cost minus the salvage value. So that'd be 36 minus 30. We'd divide it by the total miles driven, and we would get 30 cents a mile. So if we were doing this by year, we'd just take, okay, how many miles did we drive during the year? And we'd take that number of miles times the rate here, and that would be how we'd get our first year depreciation. If we were doing this on a monthly basis, which some companies do annual, some companies do monthly, just depends on the company. If we were doing this on a monthly basis, how many miles do we drive in the month times the rate? That would be how much depreciation we'd recognize for that month. So let's say in year 1, we drive 20,000 miles. We'd take 20,000 times the rate, and we would get 6,000. So our journal entry would be a debit to depreciation expense for 6,000 and a credit to accumulated depreciation for 6,000. For year 2, we drive 15,000 miles. So we'd take 15,000 times 30 cents a mile. We'd get 4,500, and we would just debit depreciation expense for 4,500 and credit accumulated depreciation for 4,500. So this is depreciation based only on usage, and doesn't matter. Time really doesn't matter with this. It's just how much are you using the asset. Now, one thing I will say that's a little different from what we looked at with straight line is that it doesn't matter when during the year you purchased the asset. It's just how much did you use it. So if you buy it in December, how much did you use it in the month of December, or how much did you use it for the end of the year? If you bought it in January, how much did you use it in January if you're doing it monthly, or how much did you use it for the end of the year? That's the only thing that matters. So there's not really anything really to do with time or when you bought it during that first year. It's just how much did you use it. So that is one difference from straight line. So let's look at the last method now. And really the depreciation methods, this is really the meat of the chapter. This is, kind of the main thing of the chapter, really. So we've got declining balance method. And this is an accelerated method, which means that a lot more depreciation is going to be taken out on the front end than the back end. And a lot of companies like this because it saves them money on their taxes. Basically, what companies can do is they can use this method, and they're going to get a lot more depreciation expense on the front end, which is going to allow them to lower their net income and pay less in taxes. So they're going to get to recoup the cost of the equipment more on the front end rather than waiting. So a lot of companies do really like this method. So let's look at an example. So again, let's say on January 2nd, we purchased a truck for $36,000, useful life of 5 years, salvage value of $6,000. This is basically the same example we've used in the other ones. So our rate of depreciation, the first thing you want to do with double declining or declining balance method is you want to figure the rate of depreciation. So you want to In this case, always take the number 2 and divide it by the useful life. Always the number 2 divided by the useful life. So in this case, our rate of depreciation is going to be 40%. So I've built a little chart here, and a little chart like this is extremely valuable for doing declining balance method depreciation. So let's say, for example, so another kind of thing that's going to be different with declining balance is it's the only one that starts with cost. So we're going to start depreciating from cost. If you noticed, units of production, straight line, they started depreciating at cost minus the salvage value. That's where they did. This, you start at cost. And then you're going to depreciate it down to salvage value. You have to stop depreciating it at salvage value. So it's a little bit different way of doing it than what you saw with the other methods. So in this case here, we have 36,000. We would start with. We would take that times 40% in year 1, and we would get depreciation expense of 14,400 in year 1, and accumulated depreciation of 14,400 in year 1, which would then give us a new book value of the cost minus accumulated depreciation of 21,600 at the end of year 1. So notice that our journal entry for year 1, if we were doing this at the end of the year, and this one you tend to do it yearly if you're going to do this one. This one I don't know if I've seen anybody do it monthly. So I think this is one that you would tend to do annually if you were going to do it. And so you would debit depreciation expense again for 14,400, credit accumulated depreciation for 14,400. So it's an accelerated method, because if we go back up to the top, notice that when we did straight line, we only took 6,000 per year for straight line. Doing a full first year's depreciation, we only took 6,000 in depreciation. But notice here that with declining balance, we took 14,400 depreciation for year 1. That is quite a bit of depreciation, a lot more than straight line. Year 2, we take the 40% times the end of year 1 book value, which is 21,600. We'd have 8,640 depreciation for that year. That would be added to our accelerated depreciation, or accumulated depreciation. Then that would be backed out of our cost to come down to our new book value of 12,960. Then for year 3, we'd do the same thing. We'd take the 40% times the new book value, get 5,184, add it to our accumulated depreciation, take it out of our book value, and we've got 1,776. And then this last year, we'd take 40% of the 1,776, except the one thing is we have to stop depreciating at the salvage value. So we would only be able to take 1,776 in depreciation in year 4, because we have to stop at the salvage value. So sometimes during the last year, you will not be able to take the full amount of depreciation because of this, because you have to stop at the salvage value. Notice again that all the journal entries were done the same way. Just every year, whatever the depreciation was, you recorded the entry. Now, another thing I kind of wanted to say about declining balance is that when it comes to declining balance, notice a lot of times that you will fully depreciate an asset before you get to its end of its useful life. This was basically what happened here. This asset was fully depreciated in 4 years instead of 5, which was its useful life. Because of that, what will happen is some companies, like at the very end, like in this case, year 4, they've only got a really small balance left to go. They'll switch over to straight line, use that for the last couple of years. The only reason being is that so every year that, or basically the depreciation would match up with the useful life of the asset. So sometimes you will see that. Now, one thing I did want to say here is let's talk about a quick example here again, we purchased the truck on April 1st, and this was the same one that we looked at in relation to the straight line earlier on. So let's say we had a truck, we purchased it on April 1st, which means we only had it for 9 months of the year. Again, it's the same information as we've looked at so far, and we figured our rate of depreciation by taking the number 2, dividing it by the useful life. Still, it's going to be 40%. Now, the one difference that we're going to do here is in year 1, we're going to take 40% of the book value, but notice that we can only recognize 75% of the depreciation. Because since we bought the truck on April 1st, we only had it for 9 months, which is 75% of the year. So we're only going to take 10.8 in depreciation in year 1. Then year 2, we take, again, our book value as of the end of the year times the rate of depreciation, and we work our way right down the list, basically. And again, we stop at the salvage value. So the one difference is that if you're doing declining balance during the first year, if you didn't buy it in January, whatever portion of the year you're going to have to take out when you do your first depreciation calculation. So in this case, 75% of the year. So we would only record 75% of the depreciation for year 1 in this case. So, and then the journal entries would be recognized all basically the same, for the amounts basically that we figured here. So depreciation is the main thing. Make sure you understand these 3 methods, really the main thing in this chapter. So thank you and have a great day. Bye-bye.